I thought I would start by asking about asset allocation after the incredible fall that we've seen in treasuries. It's not just treasuries, though. Bonds have had an incredibly tough quarter, no matter whether you're looking at sovereigns or corporates. What does this mean to you?
Yeah, listen, we talked about this before. We know that the standard 60/40 portfolio in the coming cycle is having a much tougher climb. It's likely to deliver lower returns, especially in real terms. And I think the bond market is not going to help you that much with risk management. If anything, it's going to cost you and drive risk. That's a big difference to the last cycle where growth volatility drove rates volatility. And at the margin, you had this virtuous relationship between equities and bonds. Now rates volatility can drive growth volatility. And that actually becomes a vicious cycle between the two. So I think at the margin, we are kind of avoiding duration. In our asset allocation, we've been underweight both credit and sovereign bonds.
Okay, that seems like a big statement, Christian, to say that bond markets are not going to help with risk management. Matt's been talking a lot about and we talked in our headlines about the extent to which we've seen this sell-off on bonds, and maybe it is the most in many people's lifetimes. Give us your sort of size and scope of just how material a change, how material a changed world we are in now when it comes to bond markets.
Yeah, we have a big regime shift structurally underway. And I think that is something that has been in the making for a few years. There's multiple inflationary drivers like deglobalization, decarbonization, the fight on income inequality. Some of those are moving faster in function of the COVID crisis, the Russia-Ukraine crisis. So they underlying will drive more inflation in the coming years, most likely. But I think to your point, I think bond yields have now moved up a lot. So I'm not saying that bonds cannot buffer if we're facing a recession risk and the market focuses on that topic again. The more bond yields go up, the more there is a bit of a buffer. But you have to also be careful about how much an asset, like a safe asset, buffers you in risk off relative to how much it costs you in risk on. And I think that trade-off is not as good anymore.